Welcome to episode 2 of my 6-part buyer series. What I want to talk about today is qualifying for a loan. Now, most of us aren't in a position where we can buy a home with cash, so we end up needing to obtain a mortgage. And let me start out by saying that I am not a mortgage officer. My goal here today is to kind of give you a broad overview of how the process works so that you are a little bit more familiar with it when you do start that conversation with your lender. Now, lenders are going to qualify you based on something called a DTI ratio. And what that stands for is debt to income ratio. It depends on the type of loan you get, your credit, and other things like that. But most of the time, the allowable DTI is between 40 and 50%. So let's use 45% in our example today to kind of split the difference. But basically what that means is that the lender will allow your total debt obligations to be 45% of your total monthly income. So if you make $5,000 a month, then that would mean that you can have $2,250 of monthly debt and still qualify for a mortgage. So that's going to include the mortgage payment plus any additional debt that you may have. Most of us have a car payment or credit card payments, things like that, and that's going to count towards that total monthly debt. Student debt is a little bit different, so I'm going to set that aside for this conversation. But let's assume you have a car payment of about $300 a month. That would mean that your monthly mortgage payment could be $1,950. Now, what makes up a mortgage payment? So there are 4 components that make up every mortgage payment, and it's going to be principal, interest, taxes, and insurance. The principal and interest are basically the amount you borrow times the interest rate, and then it's amortized over 30 years. And that stays the same through the life of the loan. The other 2 components are taxes and insurance. And that is variable through the years, but for the purpose of qualification, they're going to use the exact numbers at that time. In addition to those 4 components, there's some other things that could factor in as well. One of it, which would be a homeowners association, which are common in new communities. And also, if you put down less than 20%, then the lender's going to require that you obtain something called mortgage insurance. And that's going to be an additional fee that would factor into your monthly payment. So, okay, great. I can afford a monthly payment of $1,950 a month. But what is that in a purchase price? So I'm going to have to make a few assumptions to get you there. But let's say you buy a home in the city of Austin. The tax rate's about 2.15% there. And let's say you can secure an interest rate of about 2.9%, which is pretty in there right now. And let's assume that you're going to put 5% down. So you're going to have to carry that additional mortgage insurance premium. But what that means is you could afford a home that's basically between $300,000 and $325,000. So we were able to figure out an estimate of what your price range is by going through this exercise. And that's why I find it so valuable. Now there's another piece of the puzzle that we need to talk about as well with a mortgage, and that's going to be the closing costs and prepaids that are required at closing. This is in addition to your down payments. You need to be prepared for this. Closing costs plus your prepaids usually run somewhere between 2 and 4% of the purchase price. And again, it all depends on the product and things like that. But at least we can start to understand, what you need to be saving to put you in a position to be prepared to buy that home. Now, again, this is just a broad overview. I strongly encourage you to talk to a lender to get the details of what's going to best work for you. And now I also want to give you kind of my best loan pro tip here. So you've created a loan and you're making your monthly payments. At the beginning of the loan, the majority of that monthly payment actually goes to pay off the interest. So there are studies that show that if you pay the equivalent of 1 additional month's payment directly towards the principal, if you do this once a year, then you can cut up to 7 years off the life of your loan and start to build equity quicker. Most people don't know that. I like to tell my buyers at closing, but now you know. If you have any additional questions, please contact me. I am always here to help. Have a great day.